Good morning viewers and welcome back to My Finance Partner. Today we'll be talking a little bit around funding in your business, what kinds of funding there is available to you, the difference between short-term and long-term funding, how to apply for the funding, and how to make certain decisions around that. So if you've been in business for any length of time, you will understand, number one, that growth is capital intensive. And so you have the option of using your own hard-earned cash to invest or to leverage your business by getting other sources of funding. In addition to that, we'll just cover the process of what exactly you need to apply for the funding. So if we start at the beginning and just look at long-term and short-term debt and the different types. Longer-term debt is obviously something that you'll pay back over multiple periods, whether it be to a shareholder or to a bank or to somebody who specializes in asset-backed finance. And shorter-term funding would be for loans that you take for less than a year at a time. So where do we actually go to get this kind of funding? In essence, there are various tiers that you would go to get that funding. And the first would be your traditional banks, which would provide most different kinds of fundings, and we'll get into the detail of that shortly. Then you have specialist lenders who will often play in the space of invoice discounting or asset-backed finance. And then you would get people like micro lenders and other unsecured lending. Obviously, the further away you move from the traditional space, the more expensive the debt potentially becomes. So what kinds of long-term debt is there? We could go for something like a mortgage bond. We could approach shareholders for funding. We could have an asset-backed finance. So a typical example of that would be like an HP agreement, or we could get a term loan from a bank and repay them over, say, a 5-year term or something like that. On the short-term side, the typical ones there are an overdraft facility, credit card, or a very short-term loan payable back within 1 year. Those are some examples, and then obviously the shareholders are always there. One of their primary functions is to fund a business, and we could approach them. If we just think about the process of applying for a loan, it works the same no matter who you go to. There are essentially two key elements that the bankers are going to look at. What we have to bear in mind is that banks and lenders are risk managers essentially. I think a misconception though is that they don't want to lend us money and they find every single way to reject our application. That's in fact not true. They only make money if they lend, and it's important for us to understand the process that's followed in terms of what actually happens in the background. I think the first thing to remember is your client-facing people at the bank, your bank managers and the marketing people and all of that are not the same as the credit department. Those have been separated for very good reasons. And so what happens in essence is that the risk management team, the people who price your deal, will have a look at your balance sheet, so your solvency. Are you actually worth anything? And so if something were to go wrong on the loan, will there be assets, some sort of a backing for them to be able to lend against? The second thing would be around the serviceability of the loan or your liquidity, and you can read between the lines there. In your business, does it actually turn a profit or not, and what does cash flow look like? Obviously, that's very important because if we can't demonstrate that we're able to service the loan, it's very unlikely they're going to advance us the loan. And I think this is where a lot of pain is felt by business owners, where you build this perception that you're only going to get given a loan once we can prove that we actually don't need a loan, which is kind of a bit counterintuitive. Be that as it may, that is what they're going to look at. And then it's highly likely as an entrepreneur that you are going to be asked to sign surety for whatever loan. It's a difficult thing to get out of, and that is why it'll be covered in a different video, so check that out, is how to ring fence the risk that you take as a business owner and still extract something and protect it for yourself at some point in time. So now that we know what kinds of funding is available, how do we actually go about selecting what funding would be appropriate in our business? And I think the best steer I can give there is it's important to understand what you're financing. So for example, if we were looking to finance working capital, so we need to go and buy some stock, we're pretty confident the stock will flow if we can get it, but we're really short on cash, and that's the thing we're going to go and try and do. Then we will be looking at trying to get a short-term facility to fund that. It wouldn't make a lot of sense to go and take some sort of long-term funding for a working capital cycle. And then we're really looking at possibly two main options there. One would be invoice discounting. Just bear in mind that it is a very nice facility to have, and it can work incredibly well. But if we're looking at our main banking space, they're probably only going to give you invoice discounting to top grade clientele, listed clients, or possibly very big unlisted clients. So they'll be very selective, and they probably wouldn't back your entire debtors book for that. An overdraft facility is probably the most likely solution for you in terms of that, where you would go and unlock that facility, you would fund the stock, the debtor would pay you maybe 30 or 60 days later, and then you would effectively replenish your cash reserves in your overdraft facility. So that would be one example. I've had an example in practice where a business owner did have some capital. They invested it into the business in the form of a shareholder's loan, and then they deployed that loan in terms of buying a vehicle that the business used. So for people that are very risk averse, I mean, I understood the logic, it was fine, but what ended up happening there is a few short months later, the business was doing well and growing, and what happened then is the owner was short of cash, and they tried at that later stage to go and refinance the vehicle at a bank. And then the obvious thing starts happening, and banks suddenly don't believe that your vehicle is worth what you paid for it just a few short months ago. And so the better solution for them would have been to go for an HP arrangement or something like that, some sort of asset-backed finance, where we can better match the actual use and the life of the asset with the repayments of that loan term. That would have then freed that cash flow up either to reinvest in the business into the stock, or more importantly as an entrepreneur, to then extract whatever you had loaned into the business back out and redeploy that elsewhere in your life. I think that's an important lesson for entrepreneurs. We've said it a few times, is ultimately where you'd want to get to is it's fine to use your own funding. You would invest it into a business. You hope that the business does well and cash flow comes right fairly quickly. And then what you'd seek to do is to get your capital back into your own space for redeployment into your next big venture or next big project. And if you do that successfully for a few times, that's how you would create wealth for yourself. Let's just look at a couple of those options in a bit more depth. Invoice discounting, what is it actually? Effectively, you would sell your invoice that you've made to a customer before you've collected cash to a bank or to someone who specializes in that field. They will charge you an interest rate, sometimes 2.5% or 3%. It can be quite expensive funding, but the bank would pay you immediately for that, and then they would only get paid when the debtor services that loan. In asset-backed finance, it's exactly as it sounds. You would put up as security for the loan the thing that you are buying. So if it were a car, in essence, the bank would own the car and you would pay it back. And if you defaulted, they would take that asset away. And similar with plant and equipment and other things like that. A term loan is really just a general loan from a bank where we say, look, we're building something here, we do have a good business, we need a loan over a 5-year term which we're willing to pay back to you at a particular agreed interest rate, and that's how it would go. Shareholders are required to fund businesses, but from an ideological point of view, we don't like our return being stuck in businesses, and hence that is why we would go and seek some funding to be placed directly into the business and to free up our capital as entrepreneurs. I think once we've ticked some boxes in terms of an application, a bank has had a look at our solvency and liquidity, so we've got a reasonable balance sheet, they're confident that we can pay them back. That deal would then go to the credit department to be priced, and that would effectively determine the interest rate that you're able to secure at the end of the day. An important lesson for business owners as well is if things are going reasonably well and banks offer you a facility, whether it be an overdraft, a term loan or anything like that, If you've got your own shareholders' loans stuck in a business, then it's probably worthwhile looking at the option of taking the term loan and rather extracting your cash out of the business and protecting it. And definitely, if it's some sort of an overdraft facility or short-term facility, definitely take that finance when it's on offer. Although you would pay for the facility, if you're not actually utilizing the cash in the overdraft, then obviously you don't pay for that, but you have it then for a time when you might actually need it. I hope that's sort of been helpful in trying to evaluate funding in your business, the role of it, and all of these things. And one more parting shot in this regard is, please don't underestimate the role of the tax that you pay in obtaining funding. Banks are doing this more and more through their due diligence process, and when we're saying that there's profit around or that we are solvent and liquid and all of these good things in the business, they are looking to your tax returns to prove that that is in fact the case. So although it's quite a pain point in terms of paying tax, and again we'll have a detailed video on taxation into the future, it is important and it has a role to play, because when you can prove the profitability via the tax bill, it makes your life so much easier in actually taking that to a bank and unlocking the funding that you actually need to grow your business. Thank you so much for watching, and check out our other videos as well.